In this video, we're going to talk about what determines the price of shares and why, when everyone else is selling, might actually be the best time for us to be buying. It's March 2020. You wake up and you see red everywhere in the stock market. You have a look at your favorite shares, you see Afterpay has fallen from just below $40 all the way down to $9. You think to yourself, surely they're not doing that badly, even with the coronavirus news. What's it all about anyway? Why is their share price so low? So what determines price? In a nutshell, price is determined by investor sentiment. This means that the price is dependent on what people like you and I, who are investors in the market, what we think the price of something is worth. If overall we're quite optimistic about the future and about the performance of the stock market and companies, well, that can be reflected in the price, and we're likely to see the price go up as more people compete to buy those shares, and the people that hold the shares aren't willing to sell for less than a premium. On the other hand, when there's a lot of pessimism in the market, we can expect to see, like we saw in March, dramatic drops in the price of shares, which aren't necessarily dependent on the underlying performance of those companies. So we just need to clear something up first. There's something called primary and secondary markets. Now, when you go onto your brokerage account and you buy a stock or a share, you're not actually buying that from the company itself. You know, when I first started, I thought, I'll just go onto the ETF website and I'll just buy some shares from their website, right? Well, not really. Instead, what you do is you go onto your brokerage platform, and when you buy those shares, you're actually buying them from someone else in the market who already owns them. You're not buying them from the company directly. And what that means is the company doesn't get your money when you buy the share. It's actually another investor who's already bought those shares who gets your money. And in exchange, you get the ownership of that company, the shares. This is called the secondary market. The secondary market is where investors buy and sell the shares which they already own. It's where investors are trading between other investors and not directly with the businesses themselves. On the other hand, the primary market is where a company will issue new shares, and there are two ways which I'll explain to do this. And in the primary market, that's where investors are able to buy the shares directly from the business and then therefore fund that business to, say, expand and buy some new warehouses or, expand into a different country. So two examples of the primary market is when a company, one, IPOs. This is called an initial public offering, which is where a company first goes to a publicly traded company and lists itself on a stock exchange, like the Australian Stock Exchange. During an IPO, the company raises funds directly. It sells its shares to investors in the market for a price. Once those shares have been purchased by those investors can then go into what's called the secondary market and sell them to you or I, other investors who want to buy ownership of the company, but we didn't actually buy those shares as part of an IPO. The second way in which investors are able to buy shares in the primary market is through share purchase plans, or SPPs. And basically what this means is for existing shareholders of a company, for example, Credit Corp Group, they recently did a share purchase plan where existing investors, such as myself, were able to opt in and buy new shares that they issued at a discount price cheaper than what the market price is. So for example, at the time of this company, CCP doing their share purchase plan, they issued the new shares at a price of $12.50 per share, whilst the market price during this period was somewhere around $15 a share, up to around $18, $19 per share. Which means if you're an existing investor, it's a great opportunity to buy more shares in a company that you believe in the future of at a discount. And then what you can do, as we just discussed, is you can take those shares from the primary market once they've been issued to you and you've bought them from that company. And then you can go into the secondary market and sell them straight away to other investors who weren't able to participate in the primary market. So now that we know the difference between the primary and secondary market, let's go back to what determines price. In the secondary market, if investors are quite optimistic about the future and they believe in the performance of the company and they're quite happy with the overall performance of the stock market, they're confident that if they buy at this price, it'll go up into the future because the company grows, because the economy grows, because the stock market continues to perform well. Then what will happen is that optimistic sentiment will drive the prices up, as we saw toward the end of 2019. However, when sentiment is pessimistic, when people aren't sure about the future, they're scared and they're uncertain, like we saw in March, then that leads to a situation where people rush, investors rush to sell off their stocks in order to have cash to protect themselves. Because if push comes to shove and, what we saw in March, the pandemic is much worse than we anticipated, well, that stock can't buy food and shelter. However, cash can. So investors will compete with each other to sell off their stocks at a discount because they're more concerned about preserving their wealth rather than growing wealth into the future. And this is where an opportunity presents itself. If you are like me and you're quite young and you have 30 years of investing ahead of you, well, you don't really care so much about having, too much cash to protect yourself in the short term. But you've got a long enough time horizon because you're not going to retire anytime soon. Well, maybe you will, but me, for example, I'm not going to retire anytime soon. So when all these investors are panicking and selling off their assets at a real discount, it creates the opportunity where you and I can look at that quite objectively because we know what determines price. It's sentiment, not fundamentals. So we can look at this and say, what are some good companies that fundamentally are being sold off at a real discount at the moment, below what we think their price should actually be? We can pick out those companies and we can, dig a little deeper and actually determine, now is a great time for me personally to be buying. Because I think the upside versus the downside is in my favor. So I'm willing to take that risk. That investor, they don't want that risk. They want to sell it off, even at a loss, because they would prefer cash right now. Well, you and I, we can say, we would prefer to have that stock than cash right now. We're going to take on that risk. And as we've seen since March, those of us who did that have been rewarded. Now, the important thing here is if we now look to the future and think there could be another market crash, say another pandemic wave, the corona spreads again even further, well, we can make sure we're ready such that if we see the markets tanking, rather than getting scared, we can say, hang on a minute, let's use some fundamental analysis techniques to have a look at these companies and see, are they actually good businesses? And are they on a real discount at the moment? And if so, then we can deploy some of our cash into those businesses. We can buy some shares from investors who would rather have cash. And that means that if and when the market rebounds and investor sentiment turns positive again, as we've seen since March, we stand to benefit greatly. So to wrap it up, by understanding how price is determined based on market sentiment, we can actually keep a pretty level head when there's a market downturn, and we can analyze the fundamentals of companies. And when everyone else seems to be selling, we can say, you know what? Actually, this is a great time to be buying. So if you like this video, then please give it a like and let me know in the comments what type of content you'd like to see in the future. Thank you.